Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Real estate investors are always searching for ways to grow wealth without the hassle of direct property management. That's why more people are turning to real estate syndications, a smart way to pool resources and invest in high-value properties passively. Syndications give everyday investors access to deals that would normally be out of reach, like apartment complexes or commercial developments. Over $30 billion flowed into these group investments last year, proving they're more than just a niche strategy. If you're curious about stepping into passive real estate investing, this video breaks down how syndications work and why they're gaining traction. What are real estate syndications? Real estate syndications allow a group of investors to pool their money and buy or develop large properties. Think apartment buildings, shopping centers, or industrial warehouses. Instead of handling the mortgage, tenants, or repairs yourself, a team of professionals manages everything. You invest capital and earn passive income from rent or profits when the property sells. Unlike REITs, which trade like stocks and own many properties, syndications focus on a single asset or project, giving you more control over where your money goes. And unlike direct ownership, you don't need millions or daily management duties, just enough capital to join the deal. Example: imagine 50 investors each contribute $50,000 to buy a $10 million apartment complex. The syndicator, lead operator, handles renovations, leasing, and selling the property in 5 years. Investors share the rental income and profit from the sale. The structure of a syndication deal. Most syndications follow a predictable framework. Sponsor, syndicator, the operator who finds the deal, secures financing, and manages the property. They typically invest their own money too. Investors, limited partners, passive contributors who provide capital in exchange for a share of profits. Operating agreement, legal document outlining roles, profit splits, and timelines. Profit distribution typically follows a waterfall model. Investors get paid first, then the sponsor earns a percentage after certain returns are met. Key players in a syndication. Every deal relies on these roles to succeed. Sponsor, operator, runs the show, selects properties, negotiates loans, and oversees management. Investors provide funds and trust the sponsor's expertise. Property manager handles day-to-day operations, collecting rent, repairs, etc. Legal and accounting teams ensure compliance and transparent financial reporting. Syndications work because each person plays their part. You get the rewards of real estate without the headaches. Why invest in real estate syndications? Real estate syndications offer a way to invest in large, income-producing properties without the stress of direct ownership. They combine the benefits of passive income, diversification, and access to deals that were once only available to institutional investors. Here's why more investors are choosing syndications over traditional real estate or stocks. Passive income potential, one of the biggest draws. You earn without the day-to-day work. Instead of handling tenants, repairs, or property management, the syndicator manages everything while you collect distributions. Steady cash flow. Rent from apartment complexes or commercial leases generates regular payments, often quarterly or monthly. No landlord duties. Skip the midnight plumbing calls. Your role starts and ends with funding the deal. Higher returns than stocks or REITs. Syndications often outperform public real estate investments because they focus on value-add properties with growth potential. Compared to flipping houses or owning rental properties, syndications remove the active work while keeping the financial upside. You trade sweat equity for smart capital allocation, diversification advantages. Syndications let you spread risk across property types and locations without needing a massive budget. Instead of sinking all your money into one local rental, you can invest smaller amounts across multiple high-quality assets. Broader exposure. Invest in apartments, warehouses, or retail centers across different markets. Lower individual risk. If one property underperforms, others in your portfolio can balance it out. Institutional quality assets. Most individual investors can't buy a 20-mile apartment complex alone. Syndications make it possible. By pooling funds with other investors, you gain access to high-value deals that offer stability and growth potential, something single-family rentals or REITs often can't match. When you compare syndications to other real estate investments, the trade-offs become clear. Versus solo rentals. No property management, higher cash flow, and less risk, but less control over daily decisions. Versus REITs. More targeted investments and better tax benefits, but less liquidity. Versus flipping houses. No renovation stress or unpredictable profits, but requires locking up capital for years. For investors who want strong returns without the hands-on hassle, syndications strike an ideal balance. Risks and challenges of syndication. Investing. Real estate syndications can deliver strong returns, but they're not without risks. Unlike publicly traded stocks or REITs, these investments come with unique challenges, especially if you're new to group deals. Understanding these pitfalls early helps you make smarter choices and pick the right opportunities. Illiquidity and holding periods. In a syndication, your money is tied up for years. Unlike selling a stock in seconds, exiting early usually isn't an option. Most deals last 5+ years, meaning you won't see your capital until the property sells or refinances. Why does this matter? No quick exits. Need cash fast. Syndications aren't your solution. Plan to commit funds for the full term. Market shifts. If property values drop mid-hold, you ride it out until the sponsor's strategy plays out. Refinancing delays. Even successful deals can get stuck if loan terms or rates change unexpectedly. Mitigate this by investing only what you won't need soon. Treat syndication capital like a long-term bond, not a savings account. Diversifying timelines. Stagger investments across multiple deals so liquidity needs don't clash. Thanks for watching Part 1. Stay tuned for Part 2, where we'll explore more tips and details about passive investing in real estate. See you soon! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.